The Accunet Mortgage and Realty Show is sponsored by Accunet Mortgage, an equal housing lender at MLS ID 255368, and Accunet Realty Advisors, which is a separate company from but still affiliated with Accunet Mortgage.
Putting a roof over your head without the headache. Get answers to all of your home buying questions. This is the Accunet Mortgage and Realty Show with Brian Wickert on 620 WTMJ.
And welcome all to the Accunet Mortgage and Realty Show. I'm Mark Segrist, along with Accunet Mortgage and Accunet Realty Advisors owner Brian Wickert and Chief Millennial Loan Consultant David Wickert. If you have a question or comment, give us a call or text us on the Accunet Mortgage Talk and text line. The number is 414-799-1620. Gentlemen, happy Thanksgiving weekend.
Oh, thank you, and the same to you and to all of our listeners out there. It was what a beautiful day it was on Thanksgiving. Nice and sunny, mild, relatively mild. I went golfing on Friday. It was so nice, 64 degrees. I still am no good, but or at least wildly inconsistent. But hey, our question for our first segment here in the first segment of our show, after being off for a couple of weeks due to noon Packer games, is this: if you can pay cash for a home, should you do it, or should you take a mortgage instead? So I will just start right out of the gates and say, okay, Mark, you're a normal guy. If you had a pile of cash, let's say you were sitting on $250,000, you had it in the checking account or your investment account, and you're looking to buy a $250,000 home, what would you do? Pay cash, finance some, or all of it?
My guess is yes. Finance it all. I mean, pay cash up front. If you've got the money, and you've been saving the money for the home and you have it in cash, hand over the cash. Am I right or wrong?
Oh, you would pay cash.
I would pay cash.
All right, that's all right. That's fine. That's fine. So I've got a 23-year-old single woman who has an accepted offer for just a little over $250,000. She has more than double the money in an account. She's only 23 years old, but I mentioned that. But that came from kind of an inheritance or a gift from her parents. So, it's not like she started a company. Yeah, right. At age 16 or anything like that. So, of course, I'm working with both the father and the daughter, right?
And the financial advisor.
And the financial advisor, exactly. We got them started with a rock-solid pre-approval way back in April.
The whole home buying team.
That's right. She's been on her job, by the way, a year and a half as a good in-demand college degree kind of a job, so she can definitely afford to have a mortgage. The original question was exactly the one that I posted. I posed to everybody, should you pay cash or finance some of it? And luckily, her family has R.W. Baird, a team at R.W. Baird that advises them, and they said, you need to talk to this guy, Brian Wickert, over at Accunet and find out about the possibilities of financing, because here it is.
They're a tiny bit biased, which is okay. Well, they don't want her to liquidate the money.
But what is David, former Series 7 financial advisor, what are we talking about here? Why would you possibly not pay cash and instead take out a mortgage?
It's the opportunity cost. What else could that money do?
That's exactly right. It's principal substitution. It's the opportunity cost. So you have three basic choices. If you're sitting on enough money to pay cash for this $250,000 house, you could do what a lot of people would do and what Mark would say, hey, I'm going to plunk down the whole $250,000 cash. And so what you're missing out on then is what gain could you have generated on that money had you not plunked it all down? The second choice is to borrow all of it, and as a matter of fact, in this particular instance, this single borrower would have qualified for the WIDA 30-year fixed rate, zero down. So we could have literally gone all the way to the other end of the spectrum, and she would have qualified to buy this house with nothing down. So we have those two extremes. I want you to know that I was smart enough not to even bring that up, because I knew it wasn't even on the table, because they were kind of thinking, should I put all cash down? Should I borrow 100 or 150? And in this particular case, we went with the third choice, which was the middle ground. And she is going to close this week using a $150,000, a 15-year fixed-rate mortgage at a rate of 3.375% with no points and just $509 of total closing costs, because in this unique instance, we did not need to even have an appraisal done.
Slick.
Which a lot of people don't know about, but we put every loan through Fannie Mae's automated underwriting system. And in this case, it came back and said, hey, we've seen this property before. You're putting a big down payment down because she's putting down $100,000. She's got great credit. Debt to income ratios are in line, so it's saying don't even bother getting an appraisal. And she was cool with that. So that really helped lower her closing costs. All right, so now here is some interesting math related to this $150,000 mortgage. So, and this goes to your point. So first I'm going to quiz you, Mark. If you borrowed $150,000, I'm going to tell you your monthly payment at 3.375, principal and interest together, is $1,063. So just take a wild guess. Do you think that the interest portion of that payment, Mark, is $400, $500, or $600?
I'd say $500.
Okay, good guess. Remember, my job is always to trick you, and I did. It's $422. Okay, so think about that. She's already, of that $1,063 payment, more than half, almost 60%, is going to principal at the very first payment. And what happens on a fixed-rate loan is with each payment you make, the principal portion goes up and the interest goes down. So if her investment advisors were only able to generate exactly the same return on her as she's paying on her mortgage, the 3.375, she could literally take money out of her investment account every month, use it to pay the principal and interest payment, and it would be a perfect match. She would have spent no more interest than she earned on it over the course of the 15 years. If her investment advisors were able to continue to earn her the 6% that she's been enjoying the past half decade that she's had the money, she would not only be able to withdraw from that pile of money and make her payment every month, she'd have $59,000 left over at the end of the 15-year period. And by the way, if she had 0%, if she just told her investment advisors, take that $150,000 that I'm going to borrow, and you take it out of my investment account because I don't want any risk, and I want you to put it in a shoebox, and then I'm going to take the money out of it and use it to make my mortgage payment, it would last for almost 12 years. So there is an argument to be made that cash is king. Leave it invested, because once you put it as your down payment, you cannot get at it unless you sell the house or borrow against it. All right, so that's our little story of pay cash. We have a blog post on our homepage, Accunet.com, where you can read about that in a little more detail. And when we come back, we're going to talk about a customer that I talked to this week who was looking at buying a larger home and was seriously considering making a run at a home that's about to go into foreclosure. We'll talk about that when we come back.
And you're listening to the Accunet Mortgage and Realty Show on WTMJ.
Don't break the bank to get into a house. Back to the Accunet Mortgage and Realty Show with Brian Wickert on 620 WTMJ.
And if you have a question for us, you can simply dial us at 414-799-1620. That, of course, is the Accunet Mortgage and Realty Hotline, direct line. David, I think before we're going to break, you had something you wanted to add to our discussion pertaining to whether it's best for one to offer up cash or actually finance a mortgage. Your thoughts?
Yeah, I guess just sitting on the front lines of mortgages every day, part of the consulting that a loan consultant at Accunet does is, I mean, literally, if you called in tomorrow morning, these are the words that I would offer, which is to say, if you need to pay cash because you will not be able to sleep at night unless you just have no mortgage on your house, totally cool. We are big boys and big girls enough to say, totally fine. In talking, especially with young people, and this even applies to like 5 or 10 or 20% down, to do the math to understand what the opportunity cost of that cash is. Because as I describe it, you can't just walk up to the wall in your house and pull out a $100 bill if you need it. I'm just saying, there's not an ATM in your 2x4s. And so even for retirees who might be clearing $100,000, $200,000, $300,000
from selling their big family home,
you could, if we're able to line up a mortgage for you, you could have the mortgage and still have that chunk of money sitting in your checking account, and you could just look at it
or why
for
not
weeks and months.
Invested in a risk-free 10-year Treasury bond or even a 1-year Treasury bill. We just looked up this morning is yielding 1.14%.
Right. And if at any point you just can't sleep at night, the money is still in your checking account, FDIC insured, no doubt. You can just turn around and pay off the mortgage. But you can at least, I'm going to say, retain the choice.
That's called liquidity.
Yeah.
That's what we're talking about here.
Brian and David, am I grasping
go
this
ahead.
correctly? Is the bottom line here, whenever possible, try to keep your money in play?
Well, to the degree that
You're
you're
asking
comfortable.
you're asking the two
Yeah,
mortgage
you're
guys.
asking the mortgage dealers here. Yeah, but there is a balance. So like with this 23-year-old girl, we struck a balance. If you're a retiree, and believe me, you unless you then end up getting a reverse mortgage, which is a hideous product, later on, owning your house free and clear ain't that great. Having an extra $150,000 in your retirement account that still has a chance to grow. This is all about a person's risk tolerance, is what it comes down to. I bet you were surprised at how little interest you're paying each month on that 15-year fix at $422, right?
Yeah.
I mean, that's all you're trying to beat.
Right.
Okay. So there you have it. We're here to articulate choices and give people information that they can then use.
And there is going to be a portion of the population out there that is utterly allergic to having a mortgage and getting that thing paid off as fast as possible. Power to you. We will happily tell you what the opportunity cost is of doing that.
Okay, so now over to this other customer I talked to who we helped buy a home 2 years ago, and now it's not big enough because they've had a couple more kids, I think, and so they're looking at getting a bigger home with more bedrooms. And so I had this great conversation this week, and they can afford to do that. The interesting thing was that the wife in this case had become a bit infatuated with a real fixer-upper in their same neighborhood because they're like really close to
You have
the school.
some experience with that, Dad.
I do. We talked about that, I think, on the last show. It'd been on the market since spring, had not sold, and was now on the way to foreclosure, the foreclosure auction in December. One of her questions was, could she buy the house at the foreclosure auction? Was that an option that would be hers to exercise if she wanted to? We'll give you the rest of the story when we come back.
And you're listening to the Accunet Mortgage and Realty Show right here on WTMJ.
Important home buying questions and answers you can count on. This is the Accunet Mortgage and Realty Show with Brian Wickert on 620 WTMJ.
And if you have a question or comment for our show, give us a call on the text. Text us on the Accunet Mortgage Talk and Text line. It's at 414-799-1620. Now back to Brian and Dave.
Right, so we've got this customers thinking, hey, should I show up at the foreclosure sale on the courthouse steps? David, over there?
No, I have the answer. You can do the setup.
Oh, okay. In order to buy this house when it actually goes to auction. David, your answer?
Cash is king.
That's right. Only if you are a cash buyer, because you have to be able to close in
like 7 days or something.
I think it's 10.
Okay.
10 days. So there's no way that we could get financing lined up in that short amount of time. These people don't have the cash because this house is probably going to sell in the low 400s, I think, is what it was at least last listed for. But then I did a little digging. I went on CCAP, that's the Circuit Court System, and that's a foreclosure is a lawsuit, and so it's public record. It's hanging right out there. And in addition to the first mortgage lender, so that's the person who hasn't gotten paid now for 6 months or a year, haven't received a payment, there are other potential parties who have liens against the property, like if they had a second mortgage or, unpaid bills of any kind where the creditor went and got a judgment. Well, there were 7, count them, 7 other parties had liens against this property, including our friends at the IRS.
Ooh,
and
the superseding first lien.
The Wisconsin Department of Revenue. So that is the reason why it hadn't sold. Because if you were going to try to buy this house before foreclosure, you would have had to negotiate with all those parties to say, hey, I want to buy this house and you're still owed some money, so will you take nothing? All right. And then on top of that, I also found, looking at the MLS remarks, because remember this property was listed, this in the private remarks, which goes to the buyer's agent, who then is obligated to tell any buyers this information. House needs a new roof and extensive updating. Seller does not have the funds to replace the roof or do other improvements. So that's another deal killer, because if it's so bad that the seller is admitting it needs a new roof, it would get flagged on the appraisal. And mortgage lenders will not lend on a house that is in need of a new roof.
That is material.
That is material. Unless it's in the middle of winter, but then somebody's got to put aside the money to fix it, and that would either have to be our borrower.
You probably also get to pay the property taxes for 2017
You know,
as well.
that's a good point. Those probably are delinquent too.
Sure.
So lots of reasons to run from that deal. And so my advice to this potential buyer was, let the first mortgage lender get it, because that's who's probably going to win the bidding at the foreclosure auction is the first mortgage lender. They are going to bid their outstanding mortgage amount. Now, if you're in a second, third, fourth, fifth, or in this case up to seventh lien position, your decision is whether you want to pay off everybody ahead of you and take the gamble that you can then sell this property and still have something left over to recoup your losses. I did that exactly one time, David. I don't know if you remember or how old you were. Accunet got stuck with a second mortgage on a condo in Chicago that we could not sell. Oh. And I nursed that thing along for about 2 years. The guy would make some payments and he wouldn't. And he could start the foreclosure process with the first mortgage lender. I'm just sitting there in the peanut gallery, hoping the guy sends me something. Finally, it came down to where the first mortgage lender did foreclose, and I had that decision. Like, do I want to show up at the foreclosure auction, pay off the first mortgage, and see if I can sell this condo for that, plus get some of my $40,000 back? I think that was the loan amount.
How'd that go for you?
I chickened out.
Okay.
Wisely.
Okay.
It was I've done, one smart thing, which is when I just said, okay, I'm out. And then you end up eating that whole loss. You're never going to get it back. Oofda. Once the first mortgage lender buys the house, everybody else gets blown off. Yeah. Who has a lien behind that. So anyway, my thought was, let the first mortgage lender buy it. Then maybe they'll rehab it. Maybe they'll put a new roof on it, do a couple of fixes to at least get it in saleable condition.
Marketable condition.
Or if there's some brave rehabber out there who looks at this and says, great location, I will buy it, I will put $100,000 into this, and when it's all done, I'll be able to sell it for $650, and make a profit. And there are people that do that. Yeah. Let somebody else do the hard work. All right, when we come back from the news break, we are going to talk about the Federal Reserve and the rate hike and where are rates right now. So we're going to talk about all that after the news.
And you're listening to the Accunet Mortgage and Realty Show right here on WTMJ. WTMJ News Time is 10:30. From the WTMJ Breaking News Center, here's Belinda.
Expect an extremely busy day for the workers at the Amazon.
Getting you through the home buying process. Welcome back to the Accunet Mortgage and Realty Show with Brian Wickert on 620 WTMJ.
And if you have a question or a comment, you can call us, text us on the Accunet Mortgage Talk and Text line at 414-799-1620. And Brian and David, we do have a question from a caller in Fond du Lac when you gentlemen can get to it. In reference to a floodplain issue arising after the purchase of a fixer-upper. So at this point, we'll toss it back to you.
Ooh, all right. We'll get to that right after we give you the countdown to the Federal Reserve's Open Market Committee's next meeting is 17 days, 1 hour, 24 minutes, and 2 seconds as of right now. I got that off of the CME FedWatch tool where they're counting it down. And, David, what are the chances that the Federal Reserve will raise rates 0.25% on December 13th?
91.5%.
Mm-hmm. And then is there any chance that they might raise it 0.5%?
Yeah, there are some people who think there's an 8.5% chance they'll spook the market and raise them 0.5%.
Okay, so my math is pretty good. I can do this in my head. 91.5 plus 8.5 equals 100%. That means there is 0% chance that the Federal Reserve
No. The market thinks there's a 0% chance.
That's a good point. The Fed Funds futures market is not
leaving no room for just staying put.
Okay, so that means that when the Federal Reserve does do their rate increase on the 13th, the rate that they charge banks will go up to 1.5%. So if you're a bank and you want to borrow money at the Fed funds window, you have to pay 1.5%. But you and I are not banks, so we get to borrow at the prime rate. Yes. The prime rate is going to go from 4.25% to 4.5%. And how does that compare to a year ago?
It's a full percent higher.
Yeah, so
than a year ago.
3.5 was the rate a year ago, and now it's going to be 4.5%, and that is going to impact the interest rate that everybody pays on their credit cards and on their home equity lines of credit.
Yes.
Because home equity lines of credit are tied to the prime rate. You might be paying prime plus 0. You might be paying a quarter under prime. There are banks and credit unions out there offering teaser rates for a limited amount of time.
Mm-hmm.
1.99 for the first 6 months, but then it always goes to prime plus something, depending on your credit score and how much equity you have left in your home. So that is an adjustable rate mortgage. Meanwhile, David, where did we finish the week on 30-year fixed rates, which is the opposite end of the spectrum? Prime rate's a short-term rate. Fed funds rate, short-term rate, because it can change any month. On the opposite end, 3 decades of ever-loving fixed-rate mortgage money is available
At 3.99% with, wait for it, 0 closing costs.
Whoa.
APR is 3.99.
So not any points either.
There's no points.
And this is us picking up the tab on the appraisal and everything else.
You bet.
Okay. So that's kind of remarkable. The reason that the 30-year fixed rate has stayed so low is a lack of inflation pressure. So just think about this for a second. If inflation was clicking along at 4%, you would never want to lend money to anybody at 4% because your real rate of return would be 0.
Right.
So the Fed wants to see the inflation rate get up to 2%, but it's been kind of wallowing, is that the right word? Languishing more in the 1.5% range year over year. Well, this coming week, we will get the Fed's preferred inflation measure, the Personal Consumption Expenditures Index. So in my mind, the labor market is so tight. When you got unemployment, which we are not going to get, by the way, this Friday because it's December 1st. We got to wait till the 8th to get the latest unemployment rate. The labor market's so tight that eventually that has got to seep into the cost of goods and services.
And because wages will go up, and that will translate into your hamburger is going to cost a little bit more because they got to pay for the person to make the hamburger.
That's right. And boy, let me tell you, the labor market in that industry is tight, as it is in the food service industry over at retirement homes. I hear that's tight from my mother.
Yeah.
They can't find people to work, and
they're going to have to raise the hourly
wage. Raise the wage. So right now there's no pressure coming on long-term rates because of inflation. That's why things are staying low. Hard to tell when that's going to change. The latest forecast from Fannie Mae, the biggest thing that there is in mortgages for a 30-year fixed rate, is something that I'll tell you when we come back. And when we come back, Mark, let's also take that caller with their floodplain question.
Okay, sounds great, gentlemen. You're listening to the Accunet Mortgage and Realty Show on WTMJ.
Expert advice on buying a home. Here's more of the Accunet Mortgage and Realty Show with Brian Wickert on 620 WTMJ.
And if you have a question or a comment, give us a call on our text line on the Accunet Mortgage Talk and Text line. The number here is 414-799-1620. And Brian, if you'd like that question from a listener of yours in Fond du Lac, I'll be happy to send it your way, sir.
Bring it on.
Okay, this is Mike from Fond du Lac. He says, when I bought my home, the disclosure from the company who did the floodplain check provided information and forms that said it was not in a floodplain. When I went to get the house in order to do some improvements, the new lender provided information that said, yes, it was in a floodplain, and it was actually in the floodplain 1 year before I purchased the house for the first time. Might I have any recourse from the company that provided the first mortgage or the company the mortgage company contracted to do the floodplain check? That's from Mike and Fond du Lac, guys.
Wow, that's kind of surprising. Now, there can be different results from different floodplain vendors.
And depending upon what years they're looking at the floodplain map. There's a 100-year or even a 500-year floodplain map.
Well, right, but that's supposed to come out in the rating either way. So the interesting thing in that text is that the second flood certification provider is saying, oh, this information was known a year earlier. Mm-hmm. So I think you got to talk to an attorney and say, well, first of all, there was a representation made by the seller as to whether or not they knew the property was in a floodplain. So there's one fact, to check out. Did they know? Should they have known? Then you have your lender who did a flood certification check, because that's a requirement. If you get a federally related mortgage, which is basically any mortgage.
Everybody.
Yep. then you are required to carry flood insurance if your property, the structure now, is in a flood plain. And
It's not the worst idea in the world, by the way, to have the flood insurance in case it does flood. Because we were talking about this after the hurricanes.
Well, that's true.
Okay.
But he's kind of saying he was misled by somebody, so could he get some recourse or some relief from somebody? So I think the answer is you're going to have to pay a couple $100 to talk to a real estate attorney and see if they think you've got, recourse against somebody in there, because clearly there are conflicting facts. And we've seen it where, the debate is whether the structure is inside the actual flood zone. And then the other thing you can do, by the way, is you can get a LOMA, a letter of map amendment, LOMA, and that has to be done by a certified surveyor who is on FEMA's list.
The random things that sometimes. A LOMA.
When you get to be my age, David.
Not a llama, a LOMA.
Not a llama. The llama's in Peru, where John Mercure is going. The LOMA has to do with the flood map.
Wow.
Okay, so that's the answer, is talk to an attorney. All right, so here's where Fannie Mae and Freddie Mac think interest rates are going. Not too much higher. Fannie Mae's most recent forecast is that the rate's going to go from about 3.9. By the way, they always are quoting rates where people have to pay a half a point or a point. And did David mention earlier that at low overhead Accunet, if you had 25% equity and all the other right stuff, it would be 3.99 today with no points and no loan costs whatsoever. By the way, David, do you have the 15-year fixed rate up?
3.375 with just $700 in cost. It'd be 3.39 is the APR.
Okay. All right, so Fannie is predicting that the 30-year fixed rate is going to creep up all the way to 4.2% by the end of next year. And just by the way, meanwhile, everybody knows or thinks that the Federal Reserve is going to raise short-term rates 3 more times in 2018, which would take that prime rate up from 4.5, where we think it'll be on the afternoon of December 13th. That'll take that up to 5.25. So if you're sitting there with any kind of a decent balance on your home equity line of credit, this is your alert.
Kitchen is going to keep getting more expensive.
That's right. Yeah, if you use your home equity line of credit to finance your kitchen remodel, it's going to keep getting more expensive as the economy gets better. Right. So it's not too shocking in terms of where Fannie Mae thinks interest rates are going. By the way, Fannie Mae did earn a cool $3 billion American dollars in the 3 months ending September 30th.
Wow.
Their sister company, Freddie Mac, made $4.7 billion. Now, you may or may not recall, Mark, that we taxpayers bailed them out in 2008 and 2009.
We are owners.
We are the owners
Yes.
of Fannie Mae and Freddie Mac. And so far, Fannie has paid back $165 billion to the Treasury. Freddie Mac has paid back $110 billion, so that's over $250 billion, which is 55% more than we
paid them
to bail them out.
So,
Yay!
Kind of interesting. We're making money on these guys now. All right, so anyway, that's the story is long-term rates are good. They are expected to creep higher, so that just means better to buy now or to refinance now than to wait later into 2018. When we come back, we're going to talk about the day that comes after Cyber Monday. Do you know what that day is, Mark, off the top of your head?
You're referring to Giving Tuesday, I believe.
That's correct. So we're going to tell you what Accunet's doing for Giving Tuesday after this next break.
And you're listening to the Accunet Mortgage and Realty Show on WTMJ.
Don't just find a house, find your home. Here's more of the Accunet Mortgage and Realty Show with Brian Wickert on 620 WTMJ.
And Brian, I believe before the break you were about to allude to the importance of this coming Tuesday.
That's right. It's, you got your Thanksgiving, of course, then you have your Black Friday. Then I remembered that it was Small Business Saturday. Today apparently is nothing.
Suntanning Sunday?
Suntanning Sunday? I like that. That's good. Then you got your Cyber Monday, and Tuesday is Giving Tuesday.
Having spent all that money, now please give some of it away.
Okay, well, hopefully you didn't spend it all. You You had some left over. So the good folks from Children's Hospital called us about a month ago and said, would you, Accunet, like to be our matching donation sponsor for their Giving Tuesday event? And I said, sure. And what they're trying to raise money for on Tuesday is to install special webcams in the neonatal intensive care unit, or NICU, as it's called. And so these special cameras allow parents or family members, maybe grandma and grandpa, live across the country or up north or something like that, allow you to see and interact with your baby who is, usually very unexpectedly ends up in the NICU. Those are for, really premature or really sick babies. And there's really a super duper stress reliever for the parents. Because just imagine that. And David, your cousin, my niece, had a baby, my great niece, who spent the first 3 months of her life in the NICU 7 years ago. And that is extremely stressful. So you can't literally be there every minute of every day. You might be staying at the Ronald McDonald House right next to Children's Hospital, but this new technology allows a parent or family member to look on their smartphone or iPad and see how their child is doing, even if they're not in the room with them. So we're trying to raise $50,000 to outfit all of the NICU suites with these new special webcams. And if you go to our website at Accunet.com, we've got a blog that'll tell you about that. Now, we're only matching donations if you give on Tuesday itself. That's something Children's Hospital decided, so whatever they want, I said fine and dandy. And then they're also doing a live Facebook broadcast from the NICU.
Do you know what that is?
I am about to experience that because I get to go to it. And there's going to be a family that's already experienced the super webcam, because there was a pilot program to make sure it was going to be cool and that people liked it. So tune in at noon on Tuesday for the Giving Tuesday fundraising drive for cameras in the NICU at Children's Hospital, Wisconsin. A thing you hope you never need, but if you need it, you're really glad we have that resource right here in Milwaukee. Top-notch outfit. And we'll match your donation dollar for dollar up to $25,000 American dollars. All right, so I heard Belinda Babinick at the bottom of the hour during the news talking about the new sheriff in town at the Consumer Financial Protection Bureau, which does happen to be our federal regulator, although they promise never to bother us because we're not big enough.
We can't cut billion-dollar checks like the big banks can.
They want to go after the big guys who have deep wallets. We're mainly regulated by state agencies, but it was interesting. When Cadre decided to leave, and now there's this tussle over whether or not President Trump gets to appoint his nominee, who also happens to be the budget director, or whether Cadre on his way out the door on Friday said, oh, and by the way, I appoint my deputy here to be my successor. So that'll be an interesting thing that plays out. I don't think it will impact us one bit.
Not at all.
This coming week, we again will have the inflation number that comes out. I mean, that's kind of a little esoteric, but I think the market's going to watch that. It's the inflation number called the Personal Consumption Expenditures Index, and that's the favorite inflation number of the Federal Reserve. Somehow they think that's more accurate than the Consumer Price Index. We will not have the unemployment report and the job situation report this Friday because it's not, even though it is the first Friday of the month, it's the first.
They need another week.
So that's not going to happen. Right now still happens to be, in my opinion, a great time for first-time buyers to be out there because this time of year, guess what happens? Demand goes down. People are not out there shopping for homes during the holidays.
We were joking. You bought this home, your home in winter. I bought mine in winter. Grace bought hers.
Bought her house in winter.
December.
I'm like the winter home buyer club.
Yeah.
So, there are still homes for sale. So there's less demand. That's a decent time to be a buyer. And especially maybe if you're making a minimal down payment, it's a good time because, frankly, if you're putting 3% down, that is not as attractive, even though you should and probably have a rock-solid guaranteed pre-approval from Accunet. Still, if you're competing against somebody who's putting 20% down, that's a tough sell if you're only putting 3% down. We're making it look as good as it can, saying you're good to go, but it's the appraisal risk that makes sellers worried. But if you're the only buyer, if you're the only offer, now's the time to get out there and put it down. And the other thing I was just reading about is still the ongoing myth about, I need 10% down or I need 20%. As we talked about earlier in the show, We have programs as low as 0% down, depending on your income. And that's the WIDA 30-year fixed rate program. It's great. All you got to do to find out how much you can afford as either a first-time buyer or a repeat buyer, click on that blue button at Accunet.com. That's ACCUNET.com. We're going to be off the air for a couple of weeks while the Packers play their noon games, Mark, but we'll see you back here in about 3 weeks.
A pleasure chatting with you guys this weekend. Enjoy your Sunday, okay? Very good.
Thank you.
WTMJ Conversations is up next after the news, featuring Milwaukee Bucks General Manager John Horst. I'm Mark Segrist. Have a great Sunday.
The preceding was a paid program. Advice and opinions expressed during the Accunet Mortgage and Realty show are solely that of the hosts or guests of Accunet Mortgage and Accunet Realty Advisors and not WTMJ Radio or Scripps Media Incorporated.